The global trade landscape has been anything but predictable. President Trump's aggressive tariff strategies have sent shockwaves through the markets, creating both winners and losers. The initial imposition of tariffs on Chinese goods sent the markets into a tailspin. The Dow Jones plummeted and investors ran for cover. However, subsequent moves to ease tariffs, particularly on consumer goods, have provided some relief. Europe, meanwhile, is not sitting idly by. In response to U.S. tariffs, the EU is considering digital service taxes. These taxes would primarily target American tech giants. This tit-for-tat approach highlights the interconnectedness of global trade and the potential for escalating tensions. The markets, reflecting this uncertainty, have been on a roller coaster ride. Sharp declines followed by equally swift recoveries have become the norm. This volatility underscores the fragility of the current situation. Investors are left wondering what the future holds and how best to navigate these uncharted waters. Recent weeks have seen a softening in the US-China trade war rhetoric. Both sides have engaged in talks aimed at de-escalating tensions. This has provided a much-needed reprieve for the markets, as evidenced by the recent rally. However, this thaw should be viewed with cautious optimism. Deep-seated disagreements remain. The US continues to accuse China of unfair trade practices, while China maintains its stance on protecting its domestic industries. Furthermore, while some tariffs have been rolled back, many remain in place. This creates uncertainty for businesses and investors alike. The 90-day grace period on certain tariffs is set to expire soon. This looming deadline adds another layer of complexity. Will we see a return to the trade war trenches, or can a more permanent agreement be reached? The answer to this question will undoubtedly have significant implications for the global economy. Despite the ongoing trade war concerns, there are glimmers of hope in the market. The S&P 500, after weathering the initial storm, has staged a remarkable comeback. Corporate earnings have also been surprisingly strong. Many companies, including tech giants like Microsoft, have exceeded analysts' expectations. This positive news has fueled a sense of cautious optimism among some investors. They see the recent market rebound as a sign that the worst of the trade war may be behind us. However, it is important to remember that the markets remain volatile. The S&P 500, while recovering, is still below its all-time high. Trade tensions, political uncertainties, and slowing global growth all pose potential risks. Investors would be wise to temper their enthusiasm with a healthy dose of realism. The road ahead remains uncertain, and careful navigation will be essential. Section 4. The Fed's Balancing Act rate cuts on the horizon. The Federal Reserve, often seen as the steward of the U.S. economy, faces a delicate balancing act. The ongoing trade war and its impact on economic growth have fueled speculation about potential interest rate cuts. Market watchers are eagerly awaiting the Fed's next move, with many predicting a rate cut as early as June. However, the Fed must weigh these expectations against other economic indicators. The labor market remains strong, with unemployment at historic lows. Inflation, while subdued, is still a concern. Cutting rates too aggressively could risk overheating the economy. On the other hand, failing to act could stifle growth and send the markets into a tailspin. The Fed's decision will be closely scrutinized by investors and policymakers alike. It will signal the Fed's confidence in the U.S. economy's ability to withstand the headwinds of the trade war and maintain its growth trajectory. Section 5. Strategic Positioning, Navigating Uncertainty. In these uncertain times, investors are seeking strategies to protect and grow their wealth. Diversification remains key. Traditional safe havens like gold are attracting renewed interest as a hedge against market volatility. The technology sector, while not without its challenges, continues to offer opportunities. The growth of cloud computing, artificial intelligence, and 5G is expected to continue, driving demand for tech infrastructure and services. Investors are also keeping an eye on alternative assets like Bitcoin. Bitcoin, often seen as a digital gold, has gained traction as a potential hedge against inflation and economic uncertainty. Its decentralized nature and limited supply appeal to investors seeking alternatives to traditional financial systems. However, it is important to note that Bitcoin remains a highly volatile asset. Ultimately, successful investing in today's environment requires careful research, a long-term perspective, and a willingness to adapt to changing circumstances.